Major story. It sent shockwaves through not only the multifamily industry, but commercial real estate and other parts of the economy. And that is Blackstone making a $10 billion bid for acquiring all the assets of Air Communities. Monumental stories in the multifamily industry this week, led by a new print of the Consumer Price Index, CPI, coming in much hotter than expected, really pouring cool water on the idea of any rate cuts coming anytime soon. And we may only see 1, 2, or maybe no rate cuts in 2024. We're going to dig into the numbers, talk about where rates are going, because the 10-year and other treasury rates, they've spiked too. We're 4.5% on the 10-year treasury. That is very meaningful for the multifamily industry. But maybe even much bigger story is the acquisition from Blackstone of buying Air, American Income REIT, a massive deal worth $10 billion. We've been waiting for price discovery to really start happening in the United States in multifamily, and we are really experiencing some price discovery. Calls from Blackstone saying cap rate expansion is no longer happening, that we are going to start seeing some cap rate recompression here at some point in the moderate term. Also, reports from Yardi Matrix as multifamily sets a strong early tone in 2024. We're seeing that showing up in CPI. And then from RealPage, they're strengthening their forecast for most apartment markets for 2024. And you may not be surprised the top 5 markets that they are going to say that it's going to punch above their weight class and really outperform the rest of the market. Give you a couple hints. Handful of Midwest markets in there. All right, if you're an active investor, passive, anywhere in the multifamily industry, you're a property manager, a leasing agent, you're a broker, you're in the right spot, because every single week on the Gray Report, we're breaking down all the latest research, trends, data, and giving you our original opinion of what is going on. So strap in, give us a like, a comment. Make sure you're subscribed to the Gray Capital YouTube channel so you get updates as soon as we post them. Let's get into it. Welcome back to the Gray Report, joined again by Director of Communications and Marketing, Matt Bosnagel.
Good to be here.
Matt, it's an incredible week. Very cloudy, very rainy here at the Gray Capital Studios in Indianapolis, Indiana, but an incredible week for multifamily data, news, and market movers. But so again, you're taking all week, Matt, synthesizing it. What's your initial reaction of what's changed from this week compared to last week in multifamily?
Things seem strangely getting brighter, getting hotter. There's a lot of good articles that came across, especially in the newsletter, which you can find at graycapitalllc.com/newsletter. You can sign it up for free. But a lot of stuff that I just couldn't fit in the report. There was a couple of great pieces of research from John Burns and from Cushman & Wakefield on population growth and immigration. New census data came out,
Very
so
cool.
you can find out where people are moving, whether it's the suburbs or whether it's Kansas City. But there was a lot of good stuff about the apartment market specifically, whether it's RealPage or Yardi Matrix, and also some stuff from Apartment List, basically talking about how there's a bigger recovery maybe. We're on the verge of improving fundamentals, I think, in a way that's going to compare very favorably to 2023.
Yeah.
Even though the supply is the same in terms of, well, we got a lot of it, there is going to be a lot stronger demand, I think, and a lot stronger rent growth, I'm also guessing, in this year compared to 2023.
We're going to get into that report here in a minute, Matt, but I mean, it seems like I think a lot of economists were probably discounting any real growth this year just because we've had such lackluster growth throughout 2023 and really not wanting to just make a call without like a lot of evidence because no one was really sure. And so they're like, let's just set our sights downward a little bit. Now we're being surprised a little bit more momentum, really strong demand. And the idea that even though we're still seeing a lot of supply coming online, we're not at the beginning of that anymore. We're kind of in the middle of it. And like I was looking on CoStar yesterday in Indianapolis and, new construction is down 30% year over year. Now, again, it's still slightly elevated, but we're moving past that big hump. And obviously there's absorption that needs to take place, but we are seeing growth, especially in markets in the Northeast and especially in the Midwest. But
I think
go ahead.
Just to put the pin in that discussion, I think that a lot of the, they put put in these inputs to what they think rent growth is going to do this year, and they were like, well, the supply's the same, so it's going to be the same. But I don't think that they realized how big of a factor the kind of rent growth hangover was in 2023.
True.
So 2023 was coming off the highs of rent growth, and now we're not coming off those highs. And I think that may make it easier for people to afford a little bit more when it comes to the apartment.
Yeah, no, that's a good point. Okay, Matt, major story. It sent shockwaves through not only the multifamily industry, but commercial real estate and other parts of the economy. And that is Blackstone making a $10 billion bid for acquiring all of the assets of Air Communities. Now, these are mostly properties that are in coastal markets, the Sun Belt, as well as California. And we've pulled up just, their portfolio just to kind of take a look at what some of these, where these assets are, what type of assets they are. Because for me, the major story about this is that there's a big major institutional bid for multifamily. Yeah. There have been a lot of middle market participants. You can throw great capital into that mix who have still been in the market trying to find opportunities. But the institutions have largely been on the sidelines.
It's boring. And not in a way that it is bad. Blackstone's not necessarily associated with a big risk taking. I think that's the space for smaller.
They may disagree.
Yeah,
calculated risk.
Yeah.
And this is a big risk. I mean, this is a big risk.
Yeah. But if you're that size of an institution, you can't be that volatile. I think that it's very calculated. There's $10 billion behind it. And I think that they have built up the amount of trust, and they can take probably a little bit smaller margins than a smaller outfit just because of their size.
Oh, yeah.
And so they're willing to if they don't sense the market, they can really move the market in a way that doesn't make them break the bank. Like I kind of trust if a corporation that size is making this play, I'm going to trust them a little bit more than if it was, one with, let's say, 400 units or something like that.
No, absolutely true. I mean, again, it's a lot of price discovery all at once. It's $10 billion worth of price discovery, Matt, all in a single stroke. And, but it's not as though they are, because REITs have been beat up, publicly traded REITs, but it's not like they're buying these at a massive discount. In fact, they're paying a 25% premium on top of the fair market value or the price of Air's stock price was. So now they're making the calculation that the real value, the actual fair market value of these assets are quite a bit above what's being reflected in Air's stock price. So they're going in saying, no, 25% premium on what you're currently asking. That works for us. We're going to go in and go big. And just to understand the mindset, before I get into how Blackstone's different from like your typical investor and how some of their objectives and risk tolerances are different because of their just absolute scale, I wanted to highlight this post that CRE Analyst, which is a great account to follow on LinkedIn and X as well, I'm sure. So it's a 7 messages from Blackstone's announced acquisition of AIRC for the rest of the market. So I believe this is paraphrased, but one, I just thought these are great and good conversation starters. But one, you're asleep at the wheel. They're basically saying, thanks for staying on the sidelines and plowing into credit. And I've heard a lot of, knock of people who have pivoted to kind of the debt space and preferred equity, which we've played around with that a little bit, Matt, too. Also came to some similar conclusions that they have. But anyway, I know you think debt offers equity-like returns, but there's not much upside in that underwriting. And debt platforms aren't always silver bullets. Either way, thanks for creating space for BREP, or Blackstone's real estate fund, to get opportunistic returns on core-like investments. I think that's the name of the game right now. It's what at Great Capital we've also been drilling down on, is that we can get higher if you can find assets that have incredibly attractive risk-adjusted returns. And so when they say opportunistic returns on core-like investments, meaning like they're getting mid-teens, high-teens IRRs on core investments, like really kind of trophy properties, really high-end projects that would typically be lower returns because they're less risk. They're saying we're taking less risk. We think we're going to get a much higher return.
And what do you mean? What do they mean then? Why? By creating space, like by not getting in the
Because they've
market
been on the
themselves.
sidelines.
Yeah.
And so instead of
Okay.
saying, hey, we can't make sense of the market
Yeah.
right now, we're pressing pause. In fact, we're going to be deploying some debt and we're launching a debt fund. We're going to
They're not
put
in
out
the
some
market
preferred
then.
equity.
Yeah.
They're not in the market. And then while everyone was sleeping or focused, gone over here, focused on something else, bam, $10 billion of deals gets just sucked out of the market.
Yeah.
Number two, distress is overrated. I think this is just the reality of the current situation. And it's because of actors like Blackstone that have a bid on multifamily. I mean, we've seen it throughout this year, Matt. We've talked about it a lot over the past several weeks. There are more and more buyers coming into multifamily and saying, look, I don't think we're going to see a whole lot more of cap rate compression because the long-term fundamentals are so strong. I need to get in now to get the really attractive basis, which is 20 to 30% off of, valuations a couple of years ago.
Yeah.
Okay, now if you think about that 25%, it starts to make a little bit more sense.
Yeah.
You're getting a discount. Sure, interest rates are higher, but deals are starting to pencil even with higher interest rates. Yeah. And the most important driver of returns is not your interest rate, although leverage and debt and interest rates certainly influences your return. It is your basis. You just because if you overpay by 10% and your interest rate is because your interest rate's really good, well, there's no guarantee that your value at the end of the day is going to justify that extra premium unless you're generating so much more cash flow during the life of the investment. And if interest rates go the other way when it's time to actually sell the asset, you could be in trouble because sure, you had some decent cash flow, but now you're upside down. You overpaid for it. Basis is everything. So you need the good basis now. Maybe the cash was a little bit light because of interest rates. But then if you're saying, okay, well, I don't need interest rates to drop this year or even next year, but if they drop at some point in the next 5 to 10 years, which hard to find an economist that say that they're not going to move somewhat lower over the next 5 or 10 years. Yeah. Most likely going to see some cap rate compression, prices going up. And so there's just an immediate, just natural appreciation arbitrage play, which inherently is speculative, but all investing is speculative. Yeah. Yeah. So you're making a calculated bet, which Blackstone is doing. And so taking it for what it is, this is a bet that cap rates will compress in the future. Long-term multifamily fundamentals are strong. And now it's time to take advantage of that. Well, here's the difference though, between Blackstone and like everybody else. Yeah. That all could be true and fine. If they're wrong, it's not that big of a deal for them. Yeah. They're generating fees. They're in the AUM game. Sure. Do they want to create value? Do they want their assets to appreciate? Absolutely. It's their opinion that the fundamentals are going to take care of that over time. Yeah. They need to get capital out. Yeah. They need to make investments and generate AUM. If you go to Blackstone's, website, watch their videos. They talk about how their superpower is their scale. They can shift their weight around. Yeah. $10 million is not a big deal. It was a cash acquisition. Now there's debt that's backing the actual real estate. So it's not like they're not buying the real estate for cash. They're assuming the mortgages that Air put on in place. And part of that is they're getting some really attractive assumable debt terms as well.
Kind of what I was trying to hit at is like their scale is such that they don't have to have as high of a threshold for like a great deal as a smaller guy.
No, and especially, they could have a handful of deals that they could have a handful of deals they sell back for the same price that they paid for it. Yeah. It's not going to really materially move their return to the fund. I mean, they're investing in, hundreds of assets. Yeah. And they just need the majority of them to increase in value. And that's going to be much more macro driven, like interest rates come down and cap rates compress. That's going to be the main driver, not like a little operational hiccup at one property or the other.
I do think it's worth, when we can kind of continue here, but I think it is worth taking a little bit of the counter argument just to show how, I don't know, flimsy it is or just, I want to make sure that I'm not missing anything. So interest rates are still high. That's kind of persuasive, and apartment supply is still high. Yeah. And this pessimistic, cynical take is like what we just said, is Blackstone has a little bit more of an ability to take a less profitable or lower returns deal because they have that scale.
And the risk to them of not making acquisitions is higher than making acquisitions and overpaying by a little bit.
Yeah. And then also, you could say the economy. No one knows for certain what the economy is going to do, but
even more, I agree. But even more specific than that, in multifamily, it's not like there aren't concerns that are still floating out there. I mean, we still have all these loans that are maturing. The market is absorbing it though, because there's bids at prices that basically are on par with the debt. That's what I'm seeing in most of these deals.
Yeah,
it's properties are being put on the market for basically the balance of the loan, and they're like, and owners are saying we at least want to be able to pay the mortgage off. We're fine not making any money on these properties, but I don't know how many deals we've looked at recently that they're basically being priced for the value of or the loan balance essentially. So people aren't taking losses.
Yeah,
they're just not making any money, and the lenders are being paid back in whole.
Yeah,
and there are buyers at that level. There are enough bids,
and so they were. CRE analyst was just saying, don't think about distress anymore. And I saw even more articles now that
they didn't say don't. They said it's overrated.
Yeah, it's overrated, but this is what we were even talking about last year when we kind of knew that extend and pretend would work. It's just going to make it harder for people to sell at high prices.
Yeah,
it's just going to make it that much more attractive to sell. It'll take it down a little. It won't send it overboard.
Well, and right now, so things could get worse. Like something deteriorates, or if interest rates, really start rising, and then all of a sudden the price becomes less than par, less than the value of the loan balance. That could change things, because then all of a sudden, not just the equity is getting wiped out, but people are taking real losses, and banks are having to cover, or they're going to have to write. But again, it's not like they're not getting half the balance back. We're talking about right now, they're getting the full balance back. And if things get worse, maybe they're going to get, 95% or 90%. And so, the major concerns of this snowballing, and I think the extended pretend has allowed the market to spread out the pain over a longer period of time and is better adept at absorbing it. Probably because they saw our loan maturities report last year, Matt, and they saw that big wall, and they were like, we got to spread this thing out.
We helped.
We saw it coming. Knowledge is power. But essentially, we're not leading ourselves towards this like CRE crisis of where banks are just taking losses. Right now, there's nothing to show that banks are going to really take any losses. They just have to work through and get their loans back out get their capital back and get loans back out at higher rates.
So whether it's distress or any of these really reasons, but I was kind of keying in with the high. So if it's a bad market because of higher interest rates and apartment supply, that is a finite thing.
Even short-term,
even interest rates that keep getting pushed back, like no one's thinking
they're transient.
They're transient. That's right. But like every single apartment investor, if you're worth your salt, is looking beyond 2024. And so that makes a whole lot more sense for them to make this move right now, because their eyes are on 2026.
It's just who has the cojones to say, all right, I'm going to go and get the basis now.
Yeah.
It's hard to bake in much growth, even though I think a lot of people are coming around and our gut is that we're going to see some really strong growth probably this year, and especially end of 25, 2026. But still, no one's really factoring in much growth. And then if you're factoring in, we're going to stay at these interest rates for a long time, a conservative underwrite, which that doesn't exist. But like, let's say you did it and you're not trying to really speculate at all. And you're not getting aggressive with your business plan. You're not really pushing it. You're like, well, things are just okay. Which, why would you go and buy a multi-million-dollar thing and just be like, it's going to be okay. But anyway, so you have to say, okay, these returns at the face value, looking at it super conservatively, aren't enough to get me excited. But my gut is telling me, and the data that I'm looking at, that things are actually going to get better. Yeah. And I'm going to look at this basis as a long-term play, because you can't say, well, this is going to turn around in 2 or 3 years, even though that may be their trajectory, but there's too much risk if you need it to happen over a short period of time. And so, hey, look, I'm going to buy this at a huge discount. Yeah. The cost to carry with the interest rate, it's more than I'd like to pay, but the value that's going to be created through cap rate compression over the next 5 years is going to make that high interest rate just like so immaterial, it doesn't matter.
Especially if you have cash and you don't even use any loan. supposedly they
Yeah.
have 65 billion in dry powder. Now, I don't know if the 10 billion came from previous 75,
Mm.
but that's a big chunk of their dry powder if they're using it on all cash. I'm not really quite sure.
Yeah. Well, it's an all cash purchase
Okay,
of the stock,
there you go then.
but the ownership, they're
Mhm.
assuming the debt. So there's still the properties aren't
Okay,
being
okay.
purchased
Yeah.
with cash.
Yeah,
They're
yeah.
assuming the loans, or most of the loans, I'm sure,
Mhm.
on the assets. So they're all going to be fine. They're all financed,
Yeah,
but
yeah.
they're buying out
Okay,
all the
okay.
ownership and holding companies.
Well, like even considering the good side, the bad side, it really is hard to see uh, a foothold for the bad side. As much as I'd like to be an optimist here, and it's only because these interest rates and apartment supply picture is going to be
Well,
so much different next year.
true. I think to your point, Matt, I mean, I think there's reason for optimism. It's also the time where things can go wrong because we can get overly optimistic
Mhm.
and start to ignore the risks. So you
Yeah.
still need to, have the head on a swivel. I mean, the way that interest rates have been moving are a major reminder of that,
Yeah.
is that we're not fully out of the woods yet.
Mhm.
Because those higher rates are still coming around, knocking. But just to finish this point, because this is like the big one.
Mhm.
The other ones are, I think, are mine less than, they're all important, but in a place that helps, income growth matters, and then some comments on New York and California love, sure. But it's this number 3, cap rate expansion is over.
Mhm.
Nothing was trading 6 to 12 months ago, which left many people eyeing worst case scenarios. This is from Sierra Analyst, paraphrasing from Blackstone's comments. But the market has shifted a lot in the last 6 months. 4 to 5% treasuries are workable, especially with SASB spreads coming in. The agency spreads, we can generate mid-teens returns by buying in the 5s and generating a few hundred basis points of cash flow growth. Any further interest rate and or cap rates decline are gravy.
Yeah.
I think it's a great way to look at it. We can make deals. I mean, this is like our River Club deal right now. They're getting ready to
Mhm.
close, man. Base case, solid deal. Kind of higher mid-teens returns. Nothing, I think, worth getting excited about. That doesn't take into account interest rates coming down or cap rate compression. If you see that happens, then it's, again, we're getting not just the taters and the turkey, we're getting the gravy loaded up, and it's like seasoned and good.
Now, I think that they said the gun's already been fired and the turkey's already been baked.
Yeah,
But
they're just
I
waiting for
think
the
that there
gravy.
is a little bit of time for people to go and grab some deals. And I don't think that there was the fervor that there was in 2022. But
No. It's not over exuberance paying whatever and with crazy fast terms and
Yeah.
crazy hard money. No, it's still it's a buyer's market right now.
but the way that things go, it could be a seller's market. By the time you start now, the prices could be so much different by the time you find a deal.
Yeah, and I think it's going to require a lot of flexibility, ability to be nimble, looking at things maybe you would not have looked at in the past, or re-looking at something or a strategy.
Yeah.
Because I think it's a market, unless you're a Blackstone, beggars absolutely can't really be choosers.
Mhm.
You need to have criteria. You should stick to your criteria, but also, don't be an absolutist and have some flexibility and say, if all of your boxes are being checked except for one,
Mhm.
well, let's look at how important that one unchecked box is, and if any of the other check boxes make up for it, or if
Yeah.
there's other reasons that all of a sudden make it a deal right now.
Yeah.
Because there's certain assets, certain markets, certain locations that people aren't looking at. One example, it's a contrarian opinion, would be downtown markets right
Mhm.
now. Urban CBDs
Yeah.
have struggled, from COVID environment. Investors who had liked the idea of urban assets kind of in the 2010s, that sentiment has moved to the suburbs. Let's go on the suburbs. Makes a ton of sense. They'll buy every good returning suburban deal we can get our hands on, but it's leaving a vacuum for urban CBDs.
Yeah.
And so, a question with, I guess, the assumption that no one will live in a city anymore. No one will live in downtown, or obviously it's hyperbolic, way less people, because
Yeah.
there's crime and there's homeless people, and there is crime. There's homeless people more in some markets than others. But I hear those comments more from people who haven't been downtown since COVID
Mhm.
than people who are downtown like every day.
Yeah.
And so I think that there is a little bit of information gap, and I think you're going to start seeing opportunities, some opportunities that look a little bit different, that isn't necessarily in consensus. But at the same time, you don't want to just be picking up random properties downtown that are overpriced
Yeah.
because somebody paid an insane amount when they bought it a couple of years ago and paid a 3 cap for it.
Yeah.
Well, maybe now I think if you can buy a deal in a CBD at kind of a mid 5 cap, I think that's a pretty solid deal when you couldn't buy them for a 4 cap a couple of years ago.
Yeah.
Not
For sure.
that we're going to get back down there, but if you see some rent growth and we get back down to 5-ish, a little bit below 5.
Yeah. Yeah. I definitely agree. I think that there are some of these properties, whether they're markets or submarkets, are really just a part of the town where it's against the narrative. And if you can find something that works, keep your eyes open. But it is worth reminding listeners, and maybe even reminding you that it wasn't too long ago that the Bigger Pockets CEO outlined his thesis on the multifamily crash that would continue to play out in 2024.
You're not letting this is Scott Trench, right?
Yeah, I'm just saying,
you're not letting him live this one.
Well, he made that thesis down, and I don't know if he's updated it yet, but maybe he will. Maybe
I think his mistake was he was like, I'm going to do another one of these.
Mm-hmm.
And then he looked at his one last year and he's like, how much has really changed?
Yeah.
And if he had put that out like 6 months prior, maybe it would have made more sense.
Mm-hmm.
But it seemed like it was good.
Well, maybe that marked the bottom, because this is what we're talking about: the snapshot versus looking forward in the future. If you took a snapshot then, and even if you took a snapshot now, you got high interest rates, you got low rent growth, you've got high apartment supply. Doesn't look great, but if you're looking forward and you're carrying the same information that most really, if you're not an idiot, you're going to be looking forward.
Yeah. Well, good point. And because it's worth it. If you're not an idiot, you try. But the reality is, so if you're waiting though to hear, like, get a report saying cap rates are wherever they are, like lower or higher, it's going to be 6 to 9 months stale.
Yeah,
and this is like the real time, data and bids that end up, showing up months down the road.
Yeah.
So and because of that, real estate's slow moving. We do see it'll probably be longer than we think makes sense for the market to adjust. But there is so much pent up demand. I could see it happening a little bit quicker than normal.
I agree too. Yeah. People had a taste of, this multifamily fervor. And I think that it has drawn and expanded its investor base during the pandemic to a point where it's not going to be the same as it was before. Like, I have a feeling that the normal cap rates, whatever this settles out to be, are going to be a little bit lower than they were in 2018, 2019, or whatever that pre-pandemic normal was.
Yeah. But certainly higher than they were during COVID.
Oh, for sure.
Yeah.
That will probably never happen again.
The age-old question of newish real estate investors of, what is a good cap rate, Matt, will still never be answered.
Yeah. Nope. Well, you can ask CoStar and they'll tell you something.
So they will tell you something. Okay, Matt. So that's all very important. And something else that's very important that's driving the market right now is CPI.
Great time.
New CPI print that came out on Wednesday. It's Thursday when we're doing this, April 11th. And the anticipation that it would be a little, little warm, came in a little bit hotter than we thought. Core, not as much, but headline CPI definitely hotter than most were anticipating. Not like it was crazy, but again, putting this into context, investors, market makers, and the Federal Reserve are looking at this data, not just this data, but CPI, I feel like, is one of the sexier prints that comes out, reports, trying to see what the trend of inflation is in growth and price growth. And this trend is slightly moderate growth and isn't a data point that shows the Fed that, okay, inflation is over.
Yep.
If anything, is that it's like it's not accelerating, but deflation deflation is not winning the day right now. It's kind of a stalemate.
Yeah.
I think that there are so many different ways you can look at these reports. I mean, we should talk about shelter again, because shelter's keeping it up, and they can, it's a broken record. The shelter data is so out of date. It should be ignored.
Yeah.
And so then if that's the case, what are we really talking about? And why did the bond market, 10-year treasuries move from, mid 3.3s, 3.4 to, over 3 4.5. Or
Yep.
sorry, 4.4 to 4.5. It's over at 4.5. As of today.
I did look at the big drivers of this.
Yeah.
Figuring out which ones increased last month. The biggest monthly increase was, I'm just going to get the silly ones out of the way here, because the
Okay.
biggest increase was video discs and other media, increasing by 14.7% in the last month. And then women's dress prices also jumped up 6.7%. But tied with that 6.7% is lodging away from home and gas prices. Lodging away from home, typically, go to a hotel, go to a rental home, whatever, spring break. That kind of makes sense to me.
Yeah.
But,
okay. That makes sense.
But that's not weighted as much as gas prices. Gas prices are weighted so much hugely. This is a story of gas prices.
And that's why we look at regular headline CPI versus core CPI.
Yeah.
And which core CPI takes out food and energy because energy is more volatile.
I have seen people talk about super core to take the shelter component out of it. I still don't know. I don't like it that much because shelter is such a big cost for people. I almost think
but
it's
the data. I wish people would put a different
a different one
metric
rather than taking it out. I would be more comfortable with, because shelter, food and gas are fairly volatile, but shelter is not as volatile. Almost, it could be a little more volatile because it's not responding to what's happening on the ground. But still, it's enough of people's lives that it is probably worth including.
True.
But the reason why I brought up those video discs and dresses was to say that, no, there actually are huge drivers that are clear to see. It's almost a number one. It's gas prices, and lodging away from home is a little bit, it is weighted about 0.1% of the total calculation for inflation, which is okay. There's like 300 and some categories in it, so not too bad. But still, gas prices. This is gas prices, at least the way that I read it.
So if it's just gas prices, though, I mean, that's such a temporary thing, and gas prices and oil prices are being driven up by not just the war in Ukraine, but all of the geopolitical stuff that's going on in the Middle East.
Yeah.
So there is, some fear that's being baked into all of that. And again, all of this is pretty, relatively temporary, but we're making some big moves on treasury yields. And so this is where I'm in the camp of certainly no rate cuts in June.
Yeah.
And it's going to be bumpy. The economy is growing. I mean, we talked about the rental market and absorption. Rents are growing. That's not going to be showing up in CPI because of how delayed it is. But but the economy definitely is. I wouldn't call it like too hot, but it's like it's not crashing, which is a good thing.
Yeah.
And so I think inflation will be a little bit hotter than 2%, but it doesn't seem like things are getting.
You're right.
We're not getting over our skis. Wage growth is coming in. Everything else is kind of normalizing in a way. And there's really, and if you listen to Jerome Powell, being just above 2, even though their target is 2, like it's okay. You think about setting a goal. I don't know if maybe Grant Cardone talked to Jerome Powell, but like you have to overestimate. Your goal needs to be more than what you really need.
Yeah.
Because there's so many conversations and arguments and debates prior to the pandemic about maybe the target rate should be somewhere between 2 and 3. This is great. We need some inflation. We need a little bit of growth. And so are we really at a point where, okay, I mean, there's talk now they're going to increase the Fed funds rate instead of lowering it. I just don't think we're there. I think that things aren't happening as quickly as investors want it to happen. They want it like right now.
Yeah.
And it's frustrating for us because we know where shelter is. But I think we just need to be patient. And this is certainly, I think, the stance of the Fed of like, it's happening. It's just, we've talked about it a lot. It's like, this is the direction where we know where we're going to get to. It's just that we're not sure on the time, and it's not nothing's a straight line.
Yeah. I'm willing to excuse this. I remember saying this last month. I excused it a little bit. Like, so what? All items came up 0.1% more than expectations. That was last month. Same thing happened this month. It's a little more worrying. That's
true. It's a trend. It's a trend.
I don't like it, and it does kind of give credence to maybe the thought that the economy is a little hotter, especially considering the jobs report that was just here, and PCE inflation is also it's not coming down as quickly as it could. That being said, I don't think that it's totally, I hear a quote from Greg McBride at Bankrate. This is on a couple headlines.
Hmm.
We can kiss a June rate cut goodbye. Well, I think that everyone really before this has already kissed a June rate cut goodbye. Hasn't the market kissed it goodbye? I think Meet Kevin kissed it goodbye. I mean, who else kissed it? I think we all kissed it goodbye about a month ago. So is it out of the question or not? And I think that the market was already pricing in. Like right now, I think they're pricing in at maybe September is what I've heard of, according to the futures contracts. But it would it be bold and provocative take to go against the grain here and still say that there is going to be a June rate cut? Wouldn't that be, now the consensus is, oh, we may not even see any. Maybe they'll
We're just
raise
so
it.
close to June
Yeah, yeah.
that, that's the thing. It's just like when there were calls at the very end of the year, beginning of the year of like recession in Q1. It's like we're too deep. It's too close. There's can the data move that quickly? Sure, but I don't see it happen.
I agree. Like, because right now, if you look at the graph of year-over-year change in CPI, all items, it looks like it's at a bumpy point. It is no longer the smooth, the smooth descent from the high. It is just bumping along here. And another word about the shelter inflation, whether it's rents or just shelter in general, the fact that it is about 18 or so months from of a lagging indicator means that right now we are at the point, we have probably almost just past the point when you're thinking of rents, where we're on the downward trend. So so now instead of comparing prices that were on their way up, now we are comparing prices that are on their way down. So it's going to be harder to erase that effect compared to previous months, and it may mean that instead of shelter inflation going right back down to normal, it'll go down and flatten out more gradually. And that may be the trajectory of CPI, at least how we're seeing it right now. It's just this last push towards whatever last percent, last half percent, whatever it is. It's going to be tougher to get there, just like numerically.
True. One thing for sure, man, I think there's a lot of noise in the system right now. And again, it's finding that it's filtering out the signal out of the noise is incredibly difficult. And I think I think everyone is having a hard time doing that.
Well, it's like you hear they call it sticky inflation. It's like, I like that name better than persist. Sticky's like a mess. And it is a mess. You can't untangle it. And now everyone's going to be looking for all the words are going to be going to whatever university Jerome Powell's talking to next, and they're going to be hanging on his every word, looking for any indication. Does he blink during this?
I was listening to Christine Lagarde's press conference this morning, and it's all very similar.
Yeah,
but and again, Europe and the U.S. are different. But they're seeing somewhat similar data, and I mean, to me, it seemed very confident that they're continuing to see, some relatively deflationary pressures and moving in the right direction.
Yeah.
I don't think this trend is welcomed, but again, it's balancing over tightening and or not, and over tightening or loosening too quickly, and there's risks on either side.
And I think this is just my sense, is that if the Fed is erring in their communications towards indicating anything, they would rather scare people and say they're never going to cut rates and then they do cut rates, than say they're going to cut them and then don't do it.
Well, they need to do both, because they need to say that they need to give a little bit of hope on the rate cuts, so lenders can have a hope and optimism to not like call notes from their borrowers. So be like, oh no, we still think the rates are going to come down, and you'll be able to buy that rate cap or refinance, and we'll kick it out. Okay, we'll kick it out another year because we're confident, because Jerome Powell said that things are going to be better.
Yeah.
So he's going to say all that at the same
speaking
time.
Out both sides of his mouth, probably.
They often have to, just whether it's to confuse or to kind of touch the points they need to.
Yeah.
Matt, let's dig into some fundamentals.
For sure.
What do you want to go to? The RealPage report or the Yardi?
Let's do the Yardi first, actually, because it gives a pretty good overview, and the RealPage just really emphasizes it. So both of them show how much better the multifamily market is doing, whether it's better than last month or better than last year. The headline for the Yardi Matrix report should be that this rent growth is the strongest in 20 months. It went up 0.5% month over month, and now it's up at 0.9% year over year. And Indianapolis is still among the top markets for rent growth for both monthly and yearly rent too. So it's followed behind by markets like Columbus, New York City, and Kansas City. But it's not the Sun Belt, not the Sun Belt's time yet. Although I was looking at population growth, and these Sun Belt markets are still growing. Like I mentioned,
Oh yeah.
the there's a Cushman and Wakefield article that I was reading in. Austin is, let's look at the rent growth numbers for them right here. Okay, so it is at the very bottom for year over year rent growth, but it is near the top when it comes to population growth. Not only nominal population, but percentage of population. Austin is, so many people are pouring into that city.
It's a great example of like the right trade that's been overcrowded and the timing is challenging.
Yeah,
it's like
it's
the market that's got the growth, but like everyone had the same idea, and then so it ended up paying a price that was well over where fair market value should have been and where rent levels can sustain, and so much of it is projected population growth, and people are moving to Austin, but maybe not all at once, and they all can't afford that apartment. And then there's thousands of new apartments to choose from. So
no, I agree.
I mean, it is it's interesting, Matt. I mean, the bottom 5 markets: Austin, Atlanta, Phoenix, Nashville, Raleigh, are some of the top multifamily investment markets in the country. I mean, we're the popular, where for population growth reasons, they're all Sunbelt markets. They all have different and unique drivers, and all markets that are really exciting and have a lot of great things to say about them. But can everyone just have the same idea?
Yeah.
The same idea to go to the same few markets and build the same type of really high-end luxury apartments that they will need eventually, but just too much all at once. And then even on this list going forward, I'll take Portland out of it, but Orlando, Dallas, Charlotte, these are all like the darling markets that whether it's a syndicator or institutional investors we're plowing into.
Yeah.
And what are the markets that have been outperforming? It's not the ones that were on everybody's list. New York, Columbus, Kansas City, Indy, New Jersey, Chicago. I mean, New York City's, let me tell you the difference, Matt, between New York City, Columbus, Kansas City, and Indianapolis. New York City during the pandemic lost a ton of growth.
Oh, yeah.
It was just it had a year and a half of just getting beat up.
Yeah.
Beat up. Where Columbus, Kansas City, Indianapolis just kept growing and really grew at a clip. And then didn't really slow down to the extent that other markets have. And I mean, Columbus rent growth is still just sub 5%. Kansas City and Indy, basically around 4%. In an environment where we're seeing more supply than we essentially have ever.
You were listening last week. All these multifamily markets, all these Midwest markets are getting some industrial investment too, and that's going to create some job growth. Right outside Columbus, is top for rent growth, and then they're getting that big $20 billion chip manufacturing plant. Right, that's gonna really help that market. It's gonna lead. And I was reading, it was a post by Carl Whitaker, friend of the pod.
Friend of the pod. I saw that too. It was a good post.
And he was talking about these Midwest markets like they were, and you mentioned this just too, like they're maybe the next Sunbelt markets. Like, nothing gives me goosebumps.
He's like there are quite more and more Midwestern markets that have like Sunbelt like growth.
Yeah.
Job and population growth, but you're getting a huge discount from the cap rate. And because just the markets aren't overcrowded with investors, but there's just enough liquidity in those markets to make deals happen. One big hit from institutional players will say, those markets, Columbus is becoming a little bit more institutional now, but like Indianapolis and Kansas City, Louisville, there's not the perception is there's not adequate liquidity.
Yeah.
I've never known of a deal where liquidity was an issue in Indianapolis. It's always been able to trade. There's some big deals that are on the market right now. They're going to trade.
Oh yeah,
they're going to trade.
Maybe we'll buy one. I always joke about they're going to bring in the New York guys and then they'll buy them up. And but there's an appetite for it. That's why I always kind of kid with our analysts and stuff is It's because it's not like people aren't noticing these smaller markets either. So at the same time that it's growing, there's an increasing amount of attention that's being paid.
Often you'll hear, okay, markets in the Midwest, they don't boom, but they don't bust. So they're just stable.
Hmm.
What, Carl Whitaker is pointing out is that what's happened is that they didn't boom as much as some markets,
Hmm.
but they did boom.
I enjoyed it. Yeah.
But they also didn't bust.
Yeah.
And so it's that combined compounding growth is what really adds to stability, not to mention just the fundamentals.
And that's something that we were tracking when we tracked like rent growth and the stories of these different markets. Like one of the stories was, San Francisco that didn't do well and hasn't really continued to do well. Another one was New York that really sank and is coming back, or Phoenix that was in the high and now it's on the lows. Well, the other story is markets that were a little bit high when everyone was else a skyrocket, and now they're still a little bit high. So that steadiness is really come to the benefit now, especially during this kind of uncertain period. It's gratifying, I guess, for Midwestern investors, and it may lead to, cumulatively, the Midwest may be the biggest gainer.
Exactly. So just quoting Carl's post, interestingly enough, the Midwest relative outperformance in those down years, 140 basis points, generally tends to be larger than the gap in underperforming years, 100 basis points. The difference is, of course, those stronger years only come around once in a while. If you think about this in more academic terms, reflect back to a real estate cycle quadrant-like chart, like the one posted in the comments. While most of the rest of the nation deals with hypersupply, period, the Midwest is closer to supply-demand equilibrium. And that manifests is in the form of stabilized occupancy and essentially normal rent growth. So, again, you call it boring, in the Midwest. But cash flow is not boring.
Yeah,
Matt.
yeah.
Or it's okay if it is. I don't call it boring.
Yeah.
I call it great.
And it's interesting that we might be at this moment before everyone jumps in, because the way that he's talking about it and the way that I've understand some of these quadrants is you pass through phases sometimes of like hyper supply, and then you're in your Baroque period or whatever it is.
Yeah,
and, stagnant. And then you go and you grow again. But we may be timing this really, really well right now.
Yeah, no, I agree. So that was year-over-year numbers, Matt.
Yeah.
I'm looking at the Yardi chart, just more real time month over month. The Midwest still is dominating. Month over month rent growth for all asset classes. Topping the list is Columbus, Ohio, followed by Orlando, Seattle, Charlotte, Indy, and Kansas City. Lifestyle assets, this is more A-class stuff. It's Columbus, Orlando, Charlotte, San Diego, Seattle, and Kansas City. But for month-over-month rent growth, renters by necessity asset class, this is your more workforce housing. Indianapolis tops the chart, followed by Las Vegas, Phoenix, Denver, and Kansas City.
Huge difference between the lifestyle and the renter by necessity.
Yeah.
The top five are a whole lot different. Kansas City is really the only one that shares between the two of them.
Yeah.
Yeah, that's really interesting.
Yeah. Yeah, it is. Transacted rents, renewal rents, Matt, continue to fall. So I think that's just kind of coming back in line with market, which was you probably signed some leases, year and a half ago, pretty high rents. Now the market's lower. Can't really renew somebody for higher than market because they just go get a new lease.
Now this renewal rate, they said that means monthly renewal rate means that 67.4% of people in Indianapolis renew the next year.
Yes.
That seems like, I don't know what
Indy's got, I didn't even see this earlier until now, but Indy's got top year-over-year renewal rent growth as well at 8%. San Diego, Orlando, Kansas City, Miami coming in after that, all pretty close. Fascinating.
Yeah.
I mean, again, like I know, Matt, we come off as, we're talking about the Midwest and Indianapolis all the time, but the data keeps forcing our hand. I mean, we're not like, we're not even searching for it. And we are very fortunate to
this
be
is
in
what
a great market.
I was going to note too, is they sometimes will have special kind of focuses in different areas that they focus on in these Yardi Matrix monthly multifamily reports. And this time they talked about just what we talked about earlier, which really covers the same type of stuff. Is people are extending, and they are almost like no longer pretending. I read this. There was something.
It just is what it is.
Yeah, it was. I don't know where the article was specifically, but it was like, well, all you got to do is survive. And maybe it was something that you said or something. If you just survive, then you're
I don't think
gonna
it
be
was me.
fine.
I don't
Well,
think it was me.
it's like it.
I would have said we can't just survive.
Yeah. But
We have to find a way to do more than survive. We're not surviving,
and
thriving.
yeah,
Gonna make it happen.
that's right. If you scrape by, well, but the point is, a lot
But no,
of people
that
are
has been the
scraping by.
mentality of like,
Yeah.
if you can get through this year, if you can get to 2025, a lot of that is because they think interest rates will be lower, or the supply shock will be mostly done with. That's gonna be a little bit later than.
Yeah, it's almost like
thought.
if you're the last one that survives, it's almost this idea of like, well, everyone else fell away,
It's like
and then
Hunger
I
Games.
can kind of like that, where you reap the spoils of everyone else. But I don't think it's gonna be like that. I think if you survive, you're gonna be worse off, and it's not gonna be so great if you're surviving, and you had to really scramble and compromise a lot of things.
I think if you're just surviving and hanging on, then I would agree with you. Then in 2025, you're not going to be doing that great because you're literally just going to be fighting and surviving, and you haven't punched through.
And there's enough that have done well.
Yeah, I think there's a lot of examples of groups that have continued to buy some at prices I think they've overpaid. They might be able to get through that, though, if they can get to the other side, if they put the right type of debt on it. But then also in the last really 9 months, there's been opportunities that have popped up, and there have been deals. And those are the deals that are going to turn into like the war stories of, talking in 2027, 2028 of like, we got these just incredible deals. In the whatever we're going to call this. What are we going to call this, Matt? We talked about this last week.
Oh yeah,
because it's not COVID. It is like the COVID COVID hangover. That's too long.
Yeah, I don't know.
I've heard ZERP being referred to like the crazy run up in prices and everything. But what is this? What is this?
Hangover period.
Just hangover.
Hangover period means that it was good before. It wasn't necessarily that good.
Well, so it got kind of good. It kind of got good there for a minute there. I mean,
well, yeah, for multifamily,
30% rent growth and 4% cap rates was, I mean, like a drinking binge, it was too much and unsustainable.
Yeah.
Was it a good time? For some, it was a great time.
Yeah. You got to pay for it.
If you were the designated driver, you're like, okay, well, at least I'm around, but I didn't get to go out and do that much. I don't know, man. That's not a good analogy. We appreciate all our designated drivers.
I got to come up with a better term, maybe.
I think so.
But yeah, if we want to jump to the Real Page article, it's very short, but it is impactful, I think. And it's like, well, they're saying it. That's all they got to say is this one sentence, which is their headline, that they are strengthening their forecast in most markets based on economic indicators. That means they think rent's going to go higher than they used to think.
Well, I think rents already have gone higher than they thought it would at the beginning of this year. We're in the first inning of the leasing season, and things are looking a little bit better than many had originally anticipated for this year.
Yeah,
we're going to be repeating a lot of names, but their forecasted rent changes for the year ending of 2024. Let's go at the laggards below 1%. It's going to be Austin, Orlando, San Antonio, and Tampa. I'm not going to read this whole list between 1.9 and 1. You've got markets like Atlanta, Charlotte, Dallas, Fort Lauderdale, Fort Worth, Houston, Jacksonville, Vegas, LA, Memphis, Miami, Nashville, Oakland, Phoenix, and some others. Between 2.9 and 2. This is like, okay, you guys are basically doing, kind of the average.
The former list was all Sun Belt, almost all of it except for Seattle. Sorry.
Correct. Yeah. all Sun Belt, and we'll say all Sun Belt and coastal.
Yeah.
Or just, no, you're right. And then so between 2 and 2.9, which I'd say is, more of your typical average growth, maybe a little bit subdued. But you've got markets like, these are a lot of the northeastern markets, Matt. Baltimore, Boston, Cincinnati, which is obviously Midwest, Cleveland, Denver, Greensboro, Kansas City, Milwaukee, Minneapolis, New York, Philly, Pittsburgh.
A little more Midwest.
Some Midwest, some Northeast, all good. Then the 3% or higher. They're growing beyond what you typically see in an average year. Markets like Anaheim, California, Chicago, Columbus, Detroit, Indianapolis, and San Francisco.
Wow. Well, they're really plotting a recovery for San Francisco.
I would hate to think that, Matt, we are unduly influencing the Real Page team or Carl Whitaker. I think they're a little impervious to our influence. But if anything, I think that we appreciate Carl coming on the show a couple weeks ago. If anything, I mean, my comment, this was not to Carl, this is more just the industry many years ago, is that you guys aren't even looking at this. You guys are just ignoring it. And
Yeah.
I'm not blaming anybody or anything, but, and again, I've told this story a handful of times, Matt, but I think back to pre-pandemic real estate conferences and going to the big ones like NMHC. And when they would talk about the economy, they would talk about markets.
Yeah.
They're not the only markets they would really talk about and spend, if there was an hour speech, 25 minutes would be on the Sun Belt. My math's going to be off. 20 minutes is spent on, the coast. And then, 20 minutes was spent on, some primary markets. Then 5 minutes was spent on the Midwest. If that adds up to 60.
Yeah.
So little
it's over,
time.
but that's fine.
Yeah. I need an expel.
They don't even have time for Midwest. That's what you're saying.
Literally, they're like, I'm over time. I was supposed to talk about the Midwest, and these are some Midwestern markets that exist. That was what I was. That's what I was going for from the beginning. They just didn't talk about it. And so if you were one that was there, and you're like, I'm trying to put together my investment thesis, I don't even know these parts of the country exists.
Yeah.
And I've talked to many investors, especially international investors, but investors in the U.S. who are like, what's going on there? Sure, I've heard of it, but why? I don't know anything about it. Not that they really know anything about Raleigh, Durham, other than someone's like, oh, there's a research triangle there. It's great, got great research that's going on, and it's Sun Belt and it's tax friendly and all that. Okay, that all sounds good. Not to diminish Raleigh, Durham and all that story, but there's a lot of other markets. There's some interesting stories going on that just people didn't know about. Yeah. And so it led to a concentration of investment and overinvestment in certain markets and more healthy balance in others. And I think that, I remember when Paul Fiorella from Yardi Matrix, who put the Yardi Report, reached out to us. This is less than around a year ago after he came on the show for the first time. And he said, he's like, Indianapolis is popping up. He's like, what's going on? He's like, explain to me, tell me about Indy. Why is it performing so well? No one had really taken the time to, in the national apartment research, media, whatever you want to call it, no one had really taken the time to do the deep dives, because it was focused on Nashville and Atlanta and Phoenix and Boston and New York and LA. And so I think that when they couldn't ignore it, when you're on the top, when the Midwest or region dominates the list for a year, you have to start digging into it a little bit more. And it becomes a factor in a player.
Yeah, that's a good point. Yeah.
So I think that the Midwest is getting appropriate attention. I don't think it needs any more now. Everyone needs to shut up talking about the Midwest, because we want the prices to stay good enough for us to keep doing deals.
Well,
so and, no more. It's over.
Well, but this is why deals. It was it's strange to think to have Indianapolis or Kansas City, for that matter, or Louisville, be talked about as Sunbelt-esque. Yeah, it could mean investor attention. Yeah. But also it could be a developer intention, and mostly too, job growth and population growth. This is looking forward to a big transformation in the city, and it's hard for me to imagine, because
we didn't even talk about Caitlin Clark.
Oh, yeah, coming to the Indianapolis. Yeah. So that's a big draw. But
I'm saying it's another just one other factor.
Yeah,
and in Indy has built a reputation in downtown, especially, of being a sports center. Obviously, basketball is huge in the Hoosier State. But driven by the Indiana Sports Corp. I mean, downtown was nothing was going on in the 80s, and they were like, what do we do downtown? Let's make it the amateur sports capital of the world. And, then eventually we hosted the Super Bowl, and we host the majority of NCAA stuff, and Caitlin Clark, which is completely changing women's basketball right now, from my understanding. I'm not the expert by any means.
The headlines are saying
that's the depth of my knowledge. But there's exciting stuff going on in the Midwest. It's not just, I'm saying it's semiconductors, it's EVs, population growth, it's new restaurants, it's new food scenes, it's new types of people coming in, and Caitlin Clark playing in Indianapolis is what's happening.
And I don't know if this is going to derail it a little bit, but But some
I
of this
just
is
brought up Kalen Clark.
but some of this is also cost of living.
Oh,
People are
huge,
moving.
huge.
People are moving places that are cheaper. Midwest are cheaper. People are building companies, building factories in the Midwest because their workforce and their land are a little bit cheaper than other
Politics,
places.
taxes.
So it's like this: the population is flowing towards where it's kind of balancing it in a little ways. You know, not every place has to have a bunch of mountains and beaches into it. We've got great trails in Indianapolis. And they're a lot cheaper than, you know, if you live right if Yellowstone was your backyard.
I spend time outside doing nature stuff once a week. There's a lot of great stuff to do in central Indiana, especially southern Indiana. But we want everybody to know about it. So they're going to come over here. And then, you know, the cap rates are going to go from wherever they are today much lower, and all of our current deals will make that was great, but then we're not going to be able to buy anything at a deep discount, Matt. And then that will make us, we want a balanced approach, which fortunately we're used to that in the Midwest.
I think so.
We are happy to receive our check from the Indiana Economic Development Corporation.
For continuing to have them
push. On. Yeah, we should. Well, somebody
reach out.
David Ravensburg, or we can have former Secretary of Commerce.
That's
Fred Chambers on running for governor right now.
That'd be really, really a big deal.
And it makes sense because he knows a little bit of thing or two about multifamily.
Well, I can hope. I'm going to try.
Thank you for watching The Gray Report. Make sure you have subscribed. I think the most important thing is to subscribe. We are almost at 1,000 subscribers. I know big YouTube channels, that's not that big of a deal. But for us, it's a big deal for us.
Because each and every one of our subscribers is 1,000 times smarter and better than any other subscriber to any other YouTube channel. So we appreciate that, and thank you. Yes. You can be one too.
You could be one of those smart subscribers. Our subscribers watch our videos a lot, and I think they get a decent amount out of it.
Yeah.
And it's incredibly humbling for us. And so again, if you appreciate this content, you feel like you've got anything out of it, and you'd like to continue to get pieces like this, and then it's not all long form. We've got shorts and shorter videos as well, and we know we're long-winded. So we appreciate that you're here. Again, especially if you're here still watching this,
right?
You might as well subscribe because you've listened to the whole thing. Leave us a comment. And then if you don't mind, a dislike's okay too. Honestly, sometimes the controversy is good. Some of our best performing videos, there's been some dissent, which is great. But then we'll catch you on the next one. Have a good week.
Yep.